Good day, and thank you for joining me today for our Quarter 2 of 2023 update on the Momentum Focused Fund of Funds. The past quarter has been filled with challenges and opportunities, and it is my pleasure to keep you informed about the performance of our funds and the outlook ahead. First, let's address some key global economic trends that have shaped market sentiment. Central banks worldwide have expressed hesitancy to lower interest rates until they see clear signs of sustainable improvement in underlying inflation. This cautious approach could exacerbate growth challenges in the global economy and increase the risk of a severe slowdown. In China, prospects for robust growth have weakened due to the declining global export activity, lower consumer sentiment, and an uneven housing market recovery. Now, as a result, China's growth may be more limited than initially thought compared to the government's official target of 5% for the year. On the local front, South Africa faces significant challenges, including subdued business and consumer confidence, as well as ongoing political uncertainty. The power predicament or energy crisis is a primary risk to SA's growth, keeping it flat for the remainder of the year. However, an improvement in energy supply is expected to boost growth to 1% in 2024 and 1.1% in 2025. The feasibility of reducing the budget deficit to 3.9% during the fiscal year 2023-2024 is in doubt. This is due to mounting social obligations, civil servant wage overruns, and a burdensome debt servicing. The SARB has elected to keep the repo rate stable at the July rate setting meeting, and we may be at or reaching the peak rate in the local market. However, tighter monetary policy could keep interest rates higher for much longer. In the developed markets, inflationary fears have eased slightly during the second quarter, but concerns over potential rate hikes in the US have persisted due to the very tight labor markets. There is still currently more than 1.7 job openings for every job seeker, indicating an imbalance between labor demand and supply, and this has been identified by the Fed as one of the factors potentially driving inflation. The US economy has improved after resolving the debt ceiling issue, boosting economic optimism and consumer confidence, which benefited US equities in turn. On the other hand, the Eurozone struggled with managing inflation, with the European Central Bank committed to reducing inflation back to target levels, signaling the potential for further rate hikes. China's market reopening has disappointed, impacting commodities, especially in the construction and automotive sectors, which affected iron ore markets. Oil prices have weakened due to recessionary fears in the US and Europe, and sanctions have actually redirected refined oil products back into Europe. Low Chinese demand also weakened the PGM basket, which of course is a drawback for South Africa. Now in South Africa, the Aussie, the Cap Swix, and the Swix equity indices all rose during the second quarter, with gains in financials and industrials, while resources declined sharply. Despite concerns, the South African market showed some resilience, benefiting from the supportive global economic conditions during the second quarter. Now let's turn our attention to the fund performances. Over the quarter, the funds performed admirably, driven by the global asset classes and supported by the 6.5% weakening of the rand against the US dollar. The Momentum Focused Fund of Funds delivered solid performance of between 2.1 and 3.4%, bringing the 12-month returns to between 8.3 and 14.2%, offering some real growth above inflation, which is currently printing at 6.3% over the same period. Within the funds, the Momentum Sustainable Global Equity Fund returned a very healthy 13%, but it was marginally behind the MSCI World Index with 13.9%. Performance was primarily driven by the tech-heavy growth stocks and the AI theme, which has been dominating global equity returns of late. The Momentum Global Emerging Markets Fund achieved 8.9%, outperforming the MSCI Emerging Market Index of 7.6%. And this was due to an overweight in selected Brazilian energy counters, as well as an underweight to selected Chinese stocks. Looking at our global fixed income components, our One Invest Global Bond Index Feeder Fund has advanced 5% in Rand terms, while the MGM Global Fixed Income Fund added 3.8%, both relative to the Citigroup Weekly Index of 4.6% over the quarter. Our iShares Global Property allocation aligned well with the Global REIT Index, returning 8.9%. On the local front, returns were more muted, with most mandates aside from nominal bonds ending the quarter in marginally positive territory. The local equity blend advanced 1.3%, ahead of the JSE Cap Swix Index of 1.2%. Despite gains earlier in the quarter, resources came under severe pressure due to the lower commodity prices. Looking at our underlying local equity managers, all managers aside from 91 outperformed the Cap Swix Index. Blue Alpha with 3.8%, Momentum trending with 2.3%, and M&G with 1.7% were the leading equity managers over the quarter. Looking forward, the global economic landscape remains challenging. Tighter monetary policy and inflationary concerns may impact growth in various regions. However, prospects for a turn in the economic and market cycle is anticipated as we enter 2024. So in conclusion, our funds have shown resilience and delivered solid performance in a challenging market environment. As we look ahead, we remain committed to managing risks effectively and seizing opportunities to maximize returns for our valued investors. Thank you all for your trust and your support. Good day.